Now we're going to pivot more into refined products and where do we sit going forward. So here, as we were saying over the last couple of weeks, we had that big overshot to the upside when we looked at products demand, and then that overshot to the downside. So now we're starting to get closer to where we think we're going to live, which is that, between essentially, depending on the time period, it'd be anywhere between that 14.8, 14.9 to about 15.1. And we just think that you're going to hang around that level. And again, it'll be just below where quote unquote normal is. It's just, and that's going to be that residual from a little bit less weekday travel, a little bit less weekday activity, weekend activity. Again, there's obviously going to be weather involved in that, but that'll remain strong. And the delta is essentially going to be that distillate, because gasoline, we think, is going to be fairly fixed at this point. Jet fuel, something similar. So it's going to come down to what is distillate going to show us. So if we get a warm winter, if we get a cold winter, a lot of that is going to kind of dictate of how normal are we versus other, and will that be enough to offset the loss of some of that gasoline demand. So the current for the week was 15.109 million barrels a day versus last week's, again, 14.229. When you look at that 4-week rolling average, we're right at that 2019 level. And then one of the things that we've been talking about is we're just not going to get that spike up that we saw in that 2019. Instead, it'll look something closer to 2017, 2018 of this kind of steady sideways move at this point. Again, it's just going to come down to some of that capacity. But just to reiterate some of the points that we made earlier on the European gasoline arrivals. So we did get that an increase of European gasoline arrivals up to 340,000 barrels a day, which compares to that 304,000. There's still more to come, but the bigger one that we really want to focus on is Asia, because that's where we think there's going to continue to be a fairly steady pull into the U.S. and into the North America, or the Americas in general. And when you look at September loading, shipments of clean fuels from Asia to the Americas rose to 645,000 tons as of Monday from 435,000 tons a week earlier. So you get another surge, and a lot of that is coming from China. They even though August flows were down, as we've been saying, September are going to be up a decent amount, and it should be, again, we always like to speak in historics, in seasonality, so it's going to be well above that seasonal norm because of COVID lockdowns that continued in September, slow movement because there was some of that buildup, some of that reduction in exports to prepare for the fall holiday, but now you'll start to see that change a bit. Or I should say that long weekend that continues for some, and that's going to push more into the market that we will absorb, and this would be the highest volume shipped on this route in any month since September of 2019, to give you an idea of just how much product is coming into our markets. And again, it's not even just coming into the U.S. in general, but just into markets we export into, which is why there's going to be that overhang. Distillate stocks had a draw of 2.55 million barrels. That's now 20.8 million below the 5-year average. It was all driven basically by Pad 1, which had a draw of 2.85 million, and now that's 12.8 million off of the 5-year average, where every other region is fairly stable. It's fairly, comfortable in terms of where the levels are. Some of them are just in line with the 5-year average, just below. Pad 3 had a build of 1.4 million. So again, it's going to be a matter of how much of that gets into the U.S. Remember, we did lose the Philly refiner. That again created this shortage. And we have seen that be supportive of imports, with imports going up 20,000 barrels a day. Again, most of that driven by both Pad 1 and Pad 2. So one of the things when you look at the that 29-year average, we are well below the that average point, and you can see that again it comes down to seasonality, and typically we have draws. It's just they started much earlier than normal, and this is going to be something to watch. Are we going to see a big spike in imports? Are we going to see this shift? Because when we look at the estimates for production, Distillate production was up about 13 basis points from 28.9 to about 29%, but you did get a fairly big drop in gasoline production, which went from about 66.5% to 62.6%. So almost a 4% drop in yield when we're looking at what is the setup, what are they trying to create, what is the yield of the barrel that's going through. And we just think it's going to, again, be weighted a bit heavier, which will pull in more imports because that's going to have that heavier cut. And then to try to bring down the price of gasoline because it went up again, the EPA is talking about cutting the biofuel blending for 2020, 2021, and 2022. Just to try to provide and alleviate some of these pricing pressures that remain in the system. So now when we look at distillate demand here, you can see we're essentially back to the highs of 2021, the seasonally adjusted all-time highs. We expected to spike. We just expected to spike again back within that cloud. Instead, we had that overshoot to the upside. But then when you look at that bounce off the 5-year average, we thought that bounce was going to be more aggressive. So it's just going to come down to how is it calculated? When is the product being counted as going from point A to point B? And again, that just takes some delay from one to the other, which again is just putting some of that overhang. So we do expect it to fall, but still remain well above the 5-year average and just within that top of the cloud. And now when we look at trucking, as we've been saying, we expect to see a very steady increase, not back to the peak, but again, moving closer to that 175 when you look at the index, just because there are more carloads available, truckloads available. When we look at what is available at the coast, you have containers now sitting at a 6-month high for about 6 days before it can get onto either a rail car or a truck to get to its next destination. So again, you're seeing a lot of that slack remaining in the system, which is just putting that pressure on, again, just moving this stuff through the system. So that's something that will remain. Here you had total carloads up 3.5%. Forest products, coal is going to remain very strong versus previous just because you have that shortage of stockpiles. Grains is going to remain elevated. You're going to see some of that makeup. And then when you look at metallic ores and metals, that comes down to, again, the different pieces that we're talking about, while the motor vehicle parts just are going to stay very, very soft, just given the issues that we have with supply chains, with assembly lines being reduced in order to essentially backstop because of those shortages, while intermodal continues to weaken. As we said last week, with the shortage of the chassis, with the shortage of just employees, even though theoretically we should continue to see growth in intermodals, you're going to have a tough comp from 2020 as you had that big spike to make up for some of that shortages, plus some of that supply chain overhang. So you will see some of that weigh. But in general, coal is going to remain a bright spot, metallic ores and metals, grain, farm products, and especially on the fertilizer side. And now that we're getting into the harvest, that'll accelerate as well. And then at the same time, we should see petroleum and petroleum products start to adjust, especially if that distillate shortfall continues in Pad 1, which it most likely will. Now, when we look at the Port of Los Angeles, you can see that there's on an import volume level, there's still an extensive amount of ships waiting to offload. We'll talk more about this in segment 1 of the Econ Show. There's just going to be a lot to support both trucking, both rail on this side as we continue to try to make up for the shortfalls within our system. Now, shifting to the temperature outlook, you can see that things are supposed to be fairly above normal when we go from essentially Texas up to Montana. And what is really everything west of the Mississippi is going to be above normal. And then you're going to have basic normal weather when you look at what makes up most of Pad 1. So here, Pad 1 into Pad 2, it'll be conducive for some of the harvest. It'll come down to what does precipitation look like. But realistically, we're coming into this period of, just not as much heat. This is more of going to be a driver for natural gas in terms of are people turning on extra air conditioners, running them longer, not having to use them at night. So again, that's there's not too much to talk about, but we will continue to look at this, especially as we progress into the winter months. Now, looking at gasoline, gasoline had that a big build of about 3.48 million barrels. That brings us much closer. Now we're only 5.5 million off of the 5-year average. With all of that, well, a large part of that being done or attributed to Pad 1, with Pad 1 about 6.6 million below the 5-year. But when you look at Pad 3, Pad 4, Pad 5, they're over that 5-year average. And then when we look at blending components only had a build of 610,000, but it's only 2.3 million below the 5-year average. So you're seeing some of that progress coming up, but you are seeing the shift. So even though refiners had a big increase in utilization rates, it wasn't as focused into gasoline as it was others. Given when you increase runs by 960,000 barrels, you're going to increase both. Clearly, there was still some of that was residual on the gasoline side. That will start to pivot into more of that distillate side. Now, imports had a big spike of 443,000 barrels a day. It came in at just over 1 million, which is 332,000 above the 5-year average. Again, we're still absorbing a significant amount of this spare cargoes that are in the world out there. Pad 1 had an increase of 323,000 barrels a day. Pad 3 had an increase of 126,000 barrels a day. Again, that's Pad 3 is going to be a mixture of what was residual from Ida and what was impacted by Nicholas. That will come back down. Pad 5 still staying fairly elevated, but as we talked about with what is coming from Asia, that's going to continue to be supportive into the Pad 5 level, while Pad 1 stays fairly strong. We will see a pair back from this. We're not going to stay over 1 million, just because there is some of that makeup in there, and this number has gotten a bit lumpier than normal. But this is something where we will see the drop, but it will stay above the 5-year average. It will stay strong because the arbitrage, there's money to be made bringing gasoline into our market. Now, when we shift over into the weekly U.S. gasoline demand side, here you can see that there was a small decline. Some of that decline continued a bit, but again, very, very measured in terms of what that decline is. So weekly U.S. gasoline demand fell 0.1% last week for the 5th straight weekly decline to the lowest level since the week of June 20th. And just, again, that seasonal movement continues to come through, and we've continued to see some of that overhang. Again, it's not going to be a huge drop. It's just going to be very much along seasonal lines. And we're seeing that with some of the daily data that has come out since that point, just seeing, again, some of that gradual reduction, which is why when we talk about gasoline, you're starting to get back to some of this normalcy when we look at the overshoot to the upside and then some of the management, to that downside. U.S. consumers' intentions to spend improved heading into the fall. So when you look at September, it's very similar to where we were in September. When you look at levels, the benefit now is we're on an upswing, and last September we were on a downswing. So it's going to be a question of, do we start to level off? Are we going to continue to see the up move? I think just when as we talk about in the Econ show, there's enough data to support how we're just going to kind of hold these lines. We're not going to see too much of an increase, but we're really not going to see a huge decrease either. But the question's going to, and the reason why you'll get some of that cap is just, again, price. We're seeing a lot of inflation, a lot of price increases, a lot of those pressure points that, again, are going to be some of those drivers and are going to be an overhang that I think we were going to see remain. But you still have some excess capital, some excess money, which will keep some of that activity in the market. And here's some of the overhangs that we talked about. So gasoline was up almost 2 cents to $3 just over 18 cents. And that's, again, going to be just in that overhang as people look to maybe pare back on some of those movements. And then when you look at shipments through the system, you had an increase of just over a penny in diesel, getting us to about $3, just over $3.38. And this is more of an industrial impact. This is going to be more of those issues going through. But It's also indicative of what is heating oil going to cost. How expensive it is going to be. Is it going to be to heat your house? Because the specs are much closer to, and in some areas, are the same as road fuels. So again, these are going to be some of those issues that we're going to have to look at as we go through those winter months. So then as we go a bit further, the blending components, as we said, had a small build. We're right at where we were in 2016, right below where we were in 2020. We just see a fairly steady move sideways at this point in time. Here's when we look over the last 15 years, just factoring in different, obviously the recession of 06, I should say 07, 08, what happened in 11. And here you can see that we had that drop down, and now we're just below that 15-year average. And as we've been saying, it's going to be a bit of a sideways move. There will be some increase towards that 15-year average. Like I would say that we're going to be right on the nose when you look at the 15 years. And that's going to be a fairly steady move sideways as we're now fully out of the driving season. And now when we compare it to the last 5 years, here you can see, again, that sideways move. We're still off of where we were in 2016 through 2019. And as we were saying, it's just going to be a bit more of this kind of stabilized move just below normal, if you will, as we just go sideways through the remainder of the year. And here's why, when you look at just workplace is still off, getting a little bit of love, coming back. But again, you're still over 20% below where you were previously. That's, again, that weekday activity that will be the overhang. You're starting to see a reduction in retail and recreation. You're seeing that, kind of that steady move down in just some of these activity numbers. The parks are starting to come back down again. Again, that'll be weather related. We still expect weekends to be more active than weekdays, but that you'll still get a little bit of that overhang. We're still a bit above where we were last year. So again, that's why we're not going to be where we were in 2020. There's enough to keep us above where we were in 2020, but below where we were 16 to 19. So again, kind of fitting right in the middle, as Italy had that nice little spike, which it had last year, but it just had starting to come back down. But again, it'll be more seasonal, just stronger on a seasonal level versus previous. So here's when we look at propane. So propane had a draw of 540,000 barrels, and that takes us 18.2 million below the 5-year average. So here, when you look at 2017, you start to flatten out, and you start to flatten out. It's just a matter of when do you start to flatten out. You start to get the pace of build slowing, but really not starting to see draws until you get into end of September, first week of October. So you can see that we're starting early. It's not unprecedented. It happened in 2017, but as we talked about of 17 into 18, how that became a huge issue for days of cover. Well, are they going to pause exports? What is that going to do to the market? And now we're starting to get back into this. Now, you also had some offsetting capacity. One, you had new facilities coming back online. So you had new facilities coming back online after being down because of Ida. That is going to account for some of that. But again, we're in a very tight spot as we go into the shoulder season, and as we come out of the shoulder season, you still have outdoor dining. A lot of people want to keep it. Restaurants want to keep it. That's propane heaters. How much is that going to cost? Can you get propane at that point? Are you going to start to see some of this hindrance to try to protect some of this? There's going to be a lot of things that we're going to have to look at. And that's why, again, this is a day delayed. So we will, some of this adjustment was, if you look at the previous week, you had some of that downtime from facilities that has now started to come back. So you will see days of supply. But even with this spike, we're still at the lowest level going into with the winter months. And we do have a lot more of propane consumption than we did in 2017, 2018, due to outdoor dining, due to that new COVID normal, if you will. So, and we do have more petchem capacity. We do, new facilities have come on. Yes, some of that is ethane. I'm not saying it's all here, but there's going to be some overhangs, especially as the LPG market, the international market, remains very strong, which again is going to keep some of that moving through the system. And here's where you look at U.S. Europe propylene prices climb amid outages. That has started to come down, but that's where you're seeing some of that additional pull coming on the petchem side. Now, looking at vaccinations remain fairly stable. The benefit is we're seeing an acceleration in Asia, which is going to be good for Delta, normalcy, some of this economic movements. But again, there will be some of that residual overhang just because economies aren't as good as I think people are expecting, and you're starting to see that get recognized, and that will be some of that overhang for just crude demand in general. And then when we look at the share of people vaccinated, steady climbs across the board, with again just helping to get to a bit more normalcy. India, the rate is increasing, but you're still at a fairly low level, and that's something that can be said about large parts of Asia. But again, getting and increasing the amount of people per 100, you're just going to close that gap a bit faster. Now, when we look at jet fuel, we expected to see that spike. We thought it was going to be a touch higher. Instead, it came in right here, and then we're just going to again just go sideways and just hang just below what is quote unquote normal when we look at 2016 to 2019 in general, with a small build of that again 180,000 barrels, which puts us right in line with the 5-year average. But as we go forward, we continue to see a rollover of activities. The Americas came down. Europe still remains flat. You're getting some of Asia Pacific coming back. The departure numbers increased by 0.6% week on week. Departures in the U.S. and South Korea led some growth, while departures in Southern Europe led declines. Again, you're just starting to see some more of that seasonality come through. And then globally, the passenger flight schedule for the 11 weeks ahead declined by 1.3% since last week, and it came from Asia Pacific and EMEA. And again, a lot of seasonality as things slow down. Not as much corporate flying, and just, again, people don't take vacations in the same way. And here's where, as we've been saying, passengers continue to be below where we were in 2019, but we just expect to see this movement sideways, just below 19. I mean, well above where we were in 2020, but again, not getting back to that normalcy. It'll still be just below. We'll come in and kind of kiss the low end of 2019 on those down moves. Our peak will be equivalent to the lows of 2019. And then our lows are just, as you can see, very similar in terms of that waffle up and down. It's just going to be at a midpoint that will stay about 700 to 800,000 below what is normal for going back to 2019. And then as we look at open table, things stay fairly stable with anywhere from about 5%, 0 to 5% better on the weekends, and about 10 to 15% worse on the weekdays. And now we're starting to see upward movements to 20%. Again, that's just less on the weekends, more on the weekends, less on the weekdays. And that's going to be kind of how this is going to go for at least the remainder of the year. So now we went through that, we're going to go in a bit more detail into U.S. exports and what is happening in the global market.